How do I make sure I don't sell the dream and deliver the nightmare when I'm presenting an IUL to a prospect, a prospective client? How do I make sure that the expectations that the illustration is setting, I can live up to? How do I make sure that I can sleep well at night and actually fully and 100% believe that I'm doing right by people by providing this product to them and implementing it in their financial plan, right? How do I make sure that I do that? Well, those questions and many more are going to be answered in this video. Now, if you don't know me, my name is Jim Fisher. I'm a coach to over 1,000 plus life insurance agents who are making the shift from being just a life agent to seeing themselves, to positioning themselves, and to elevating themselves in the marketplace as a retirement income professional so they can stop selling insurance and start presenting income as their offer and solution to the marketplace. And this is a great opportunity to truly deliver and act in the best interest of clients and create a great impact and dramatically increase your income in the process. And so that's where I'm coming from. And this question, this important question, comes from our free community, Advanced Market Life Agents. You can find a link below to join that community. You might be in that community watching right now. And Don in that community, he asked that. He goes, man, there's Monte Carlo simulations, there's computer simulations that really just show that these things, a lot of them just don't perform up to the expectation that was set in the illustration. I'm concerned. How do I overcome that? And it really comes down to three things. The first thing is that you are working with a carrier that allows you to structure the product for your purposes. We say that a TFRA, a tax-free retirement account, that's like kind of the label of the concept of a properly structured life insurance policy for the purpose of tax-free wealth accumulation. Question you have to answer is, are you working with a carrier that allows you to structure it for the purpose of tax-free wealth accumulation? What does that look like? Do they allow you to lower the death benefit to the minimum non-MEC level, which is basically the minimum level of insurance per the tax code in 7702, so that you can get the tax treatment and the shelter from that tax shelter of life insurance while focusing and prioritizing cash accumulation inside that shelter and that vehicle. And if you're working with a carrier that doesn't allow you to do this, suppressed to a mid-non-MEC level, you're selling an idea of all this cash accumulation, but what you've done, in fact, instead is oversold insurance, not knowing. You think that you're prioritizing cash value accumulation, and while this policy that you're working with and you're presenting does have cash value, it wasn't purposely designed and structured to maximize cash value. And so why is that the case? Well, so often the reason that you may not be aware of that is that incentives drive ignorance. The incentives of the people above you, right, IMO, FMO, and agencies, they sometimes either they're ignorant because of someone else's incentives, or their incentive keeps you ignorant, right? Not knowing. It's like, well, listen, because if we're honest, if you don't lower the death benefit to maximize cash value to solve for this problem, make sure you're delivering on the benefit that you sold, which is to accumulate a value in the policy that you can derive a tax-free income from, right? Well, if you didn't minimize the death benefit, you're going to drive higher insurance premiums, higher target premiums, and the incentives of everyone involved are going to potentially make more money. One of the things I found, though, that even though you might lower target premium, you write bigger premiums altogether. So it kind of balances out. You get more referrals, you write bigger cases. And so even though you lower on a per case basis, or a per dollar basis, how much is allocated towards insurance premium, which is what's feeding target that you get paid on, you actually wind up being way more successful. One of my agents has written $146,000 in the past 3 months in target premium following these strategies. And so he's doing right by clients and writing $146,000 in 3 months, right? So that's roughly just under $50,000 a month. I mean, if we kind of average that down a little, that's like $500,000 a year in target premium. And so you can actually be more successful by actually prioritizing the best interest of your client. It's a novel concept, I know, but most people's incentives kind of keep you. So you have to be with the right carrier. You might be asking, well, what's the right carrier? I have the answer to that. And I'll link a training below. And that training is not free. And it's not free for two reasons. Reason number one, I only want people who are serious about being retirement income professionals and taking this seriously as a career. It's requiring a small investment to prove that you're serious, because I don't want your learning to turn into knowledge. I don't just want to consume information. If you invest, people who pay attention and follow through. And so I want to actually see you achieve an outcome from this training. And so you pay like less than $100 for it. And so that's reason number one. I don't want everyone to have it. I want the serious people to have it. So you'll make a small investment. Is it 50, 60, $70? I don't know what the price is. It's the lowest we'll ever offer. And you can grab it below, or you can comment best. It's the best IUL breakdown. Not only am I going to show you the carry, but show you how to illustrate it and structure it and how to think about all the things that we're going to be talking about in this video at a deep level. And then reason number 2 is this is the same training that I give to my high-end clients who pay multiple 4 and 5 figures to access this stuff. And so I got to charge something to make sure that my clients who invest at a very high level to get trainings like this, aren't mad. And for that reason, it may not be up forever, but you can grab it. It's down below. But so what's reason number 2? Reason number 2 is you have to make sure that the index crediting strategy is reliable. What does that mean? Well, a lot of times people don't realize that there's a dirty little secret. And this is true for IULs as well as annuities. And what is that dirty little secret? Is that most indexes in the insurance products throughout the industry, they were designed and sold to the insurance company to do one thing, which is to illustrate well on a historical basis, also known as a backcasted basis. They didn't even consider how it would perform in the future. They looked at what happened in the past, what was true about markets in the past, and can I design an index that would have done really well with hindsight of knowing what's already happened in the past. And then they put those indexes in products, investment banks design them, and they sell them to the carriers, whether it's inside of an IUL or annuity. And the result is that people illustrate it. They don't know any better. And they're like, look at this, better than market returns, better than market returns. And so you have to know that your index is going to not just look good backcasted, but forecasted. And so if you don't have tools, resources like that training, or communities like Advanced Market Life Agent link below, or deep coaching like we do in Agent Shift, right? If you don't have access to resources, let me help you. Let me give you some ways to think about it, because a lot of people, the indexes that they choose, generally the safest thing to do if you don't have the tools and resources to know any better is to stay away from proprietary indexes. Now, does that mean all proprietary indexes are bad? No, but you need the education, tools, and resources to know which ones are and which ones aren't, which ones are actually going to forecast well on the basis. We have an index from Goldman Sachs in one of the products that we work on, and it's incredible. It's performed great last year. It's been out for years. It's forecasted looking good. It has 100% participation rate guarantee, and it's actually, I think the participation rate currently on the 1-year point to point is 160%. But minimum in the contract, it will never go below 100% participation, and the 1-year performance on it 6%. So what's 1.6 times 6%? It's 9.6%. That's incredible, right? So there are proprietary index, but if you don't have the resources to know which ones are good and which ones are expected to be good, and for you to meet that fiduciary responsibility of acting in the best interest of client, know why your recommendations, right? That's on you. If you can't do that, then stay away from proprietary indexes. Go with simple indexes. Go with like an S&P 500. Do not choose a version of an S&P, like a volatility control, right? A volatility control index. What does volatility control mean? Very simply, when the market is volatile, more of the interest earnings in the account sits in cash instead of into options. And so you don't get any return from cash. And so it's doing its job, keeping you away from the volatility by protecting you in cash. But generally, if you should have a long-term horizon in these products, to accumulate, you should be in just a general version of the S&P. That's the safest bet for you to do. So number 2 is the indexing strategy that you choose, right? So you have to choose one that has reliable crediting, is expected to do well on a forecasted basis. If you don't have forecasting tools to know whether proprietary indexes are good or not, then you should stick with the S&P. And you should be with a company that is going to have great rate renewal integrity, meaning that if they issue at 12% cap rate, like one of the products that we work on, an S&P with a 12% cap, that it's very consistently and likely to renew at the 12%. They don't rob Peter to pay Paul, and every year you're into your issue policy, they lower the caps to pay for their other proprietary index underperformance. Another dirty secret. So use the S&P, right? And what I like to do is illustrate on the S&P, but the final and third reason that thing that you need to focus on to make sure you don't sell the dream and deliver the nightmare is index diversification. Because what a lot of people will do is they'll choose the one index that performed well and maybe continues to perform well. But the thing is if you look at the data, it's not every year that that's the best index. And so how do you maximize crediting stability? How do you minimize the opportunity for hitting the floor so that you're getting as much interest as possible every year so you stay away from the zero floor? How do you do that? Well, you do it through index diversification, because otherwise you're trying to choose every year which one's likely to be up, and it's different in most years. And a good carrier is going to provide you resources to show you that, and you're going to see the volatility. And so what do? You spread across it. And so I might illustrate with the S&P 500, very simple, 12.5% cap, 100% participation participation up to the cap, like explain that to the client. But then when we go to apply, I'll say, hey, listen, what I'd like to do is diversify your indexes to maximize crediting every year. And if you look at this data here, historically, this is going to maximize your crediting average opportunity. And it's also going to minimize the likelihood of having a 0% floor. Even when the market's negative, maybe you can still get 2 or 3%. And that's the goal. And then we would like to diversify on that. And so those are the three things in summary. You got to be working with a carrier that allows you to structure the policy min, non, mec. We cover all this at a deep level, but very simply, allows you to go B to A. When do you convert to level from increasing, and how do you structure this min, non, mec? That's number one. Number two is you have to have a confidence index crediting strategy, with good caps and participation rates and great rate renewal against the issued caps and participation rates. And then the third one, index diversification. And for me, like index diversification might be, maybe it's an S&P strategy with a high cap. Maybe it's an S&P strategy with a bonus. Maybe it's an S&P strategy that's monthly point to point versus the year. Maybe there's a bond one, and it's very simple, right? Simple indexes that have been around for a while that I know didn't just perform in the past, but are expected to do well in the future. And those are the three things. So if this video was helpful, maybe you drop a like and subscribe to the channel for more content like this. Maybe you can join me in the comments and say, was it helpful? Because here's the thing, many people are going to come across this video just like you, and they need belief to know that this resource is valuable, and them seeing your comments to say that this was valuable to you. So if you can join me in the comments and let me know, it will inspire them and let them know this is a worthy resource to invest their time into. So would you help me in the comments, drop a like, subscribe to the channel, and if you want to get access to the best IUL breakdown, how to illustrate it, how to structure it, and access to many other trainings like it, you'll find that in the link in the description as well. I hope this video serves you, and I look forward to seeing you in our free community, maybe on one of our future coaching calls.